Don't know if you own any retail savings bonds, but now maybe a time to start looking at me. Welcome back. Still with me in the studio, Monale Ratsoma, who's the Chief Director of Liability Management at the National Treasury. We are talking retail savings bonds. And just take a look at the investment profile. There's the first board that we want to show you. That's the age category of people who are invested in this particular instrument, which is backed by government in South Africa. Monale, I would have imagined you would have seen a skew towards the older end of the market because of the security that people find in bonds. We've had a whole lot of investment consultants in this studio who've told us, when you're young, put your money into equities, move it into bonds when you get older because of the security of bonds. So I suppose that if you look at those numbers, they would be fairly predictable. But surely you guys should be looking at the two categories which bridge between 40 and 59 to try and lift those.
Yes, I mean, we really, from our part, trying to make an effort. I mean, such numbers obviously are sort of numbers that we look at during our strategy session and try to figure out ways of penetrating into much younger markets. And the introduction of the top-up bond, in fact, I think is very much earmarked at that. That perhaps the younger generation does not really have much income left or much left out of beyond their expenditure. And I mean, you can see this in fact in their debt numbers. The debt numbers that you do get from the Reserve Bank themselves do say that households are highly leveraged. And the income levels in South Africa are generally low, so most households tend to have to borrow to supplement their income. So there's nothing, in fact, left at the younger generation. Yeah. So beyond that, in the older categories, I mean, that's where perhaps some pension has already come through, and there's therefore excess funds to invest, and then there's a requirement for some security to kick in terms of the type of investment that they're looking at, and that's, I think, is very much reflected at the metrics that you see in the numbers. But more and more effort, as I indicate, Jeremy, will be earmarked at looking at the younger generation. Just throw in like a money box concept. That's what the top-up bond is going to be like.
And as you say, it is accessible, it is easy. At the end of the month, you find you have 25 Rand left, bang, just throw it in.
Indeed.
I would imagine, though, and this is a problem that you identified earlier in the show, that a fair amount of that money that's coming in at the older end of the spectrum there is savings to savings money.
Yes, I think that's what we have noticed. And we have noticed this given that, I mean, after getting 11-12 billion in, you would expect that the household saving ratio should in fact start to reflect the efforts that have been made. But in fact, there isn't really much move there. And the number is still suggesting that households are de-savers generally. So it means that this money is coming out of a bank account somewhere and coming to us. And that was not the intention. The intention was never to in fact start competing with banks. It was more to try to build a culture of savers. And more you will be seeing the rollout that's going to be coming through on the promotion side, earmarked at going to communities, deep rural communities, to try and get people to in fact save.
Now here's the statistic that this one actually blew me away. Just take a look at that. The distribution of investors per gender. The vast majority are women.
Yes. I mean, how do you explain that?
I don't know. I was hoping you were going to be able to explain.
I mean, you can think of things. I mean, you can think of hypotheses that can actually, in fact, create that. Perhaps that men die younger, and therefore it leaves women to man households, and cash is left, and therefore they save. Or women generally are more responsible. I mean, you can see. I mean, if you take a 25-year-old male and a 25-year-old female, they go looking for insurance. The 25-year-old male is likely to pay more because they're regarded as reckless and all those things. So I think women generally probably behave differently to men and look at savings differently to men. But I mean, this is not informed by any study that we have done on our part. I mean, this just to try look at what could be the hypothesis behind such trends. But
the other theory here is that you've got females who just feel like money there away from their husbands, so that their husbands don't know where the money is.
You said it. Right? You said it.
But you know what? There was a similar study done quite a few years ago by South African breweries, and I'm not trying to link South African breweries to retail savings bonds by any means, but they found that the vast majority of buyers of beer in South Africa were women. Of course they were, because they were the women who were running the shebeens. And it's just, when I looked at this number, I thought, no, wait, hang on. The Treasury has got something wrong here. But that's absolutely right. 54% of them to females.
Well, you know, to a certain degree also, I mean, as I indicated, that it could be an effect of life expectancy. It could very well be something that's matched up to our population. Well, a population metric says there are more females than there are males. And I mean, that could very well be, in its simplistic form, reflected in those numbers.
I'm still, okay, I know that we've got the high end of the market as well, where you may have somebody who's got, who needs the security, and B, who's got 2 million rand, and they've got money in equities, and they've got money in property, and they've got money in money market accounts, and they suddenly turn around and go, wait, hang on, I need some form of really good security here, so I'm going to throw it into retail savings bonds. That's the high end of the market. And that is one marketing tool that you need to use to get to. But I'm fascinated by the lower end of the market, your top-up scheme that you've been talking about, because that is A, where the vast majority of the money is, and B, it's liquid money. How do you encourage those people to part with their money for an extended length of time, because there are time constraints on these bonds?
Well, I mean, it is going to be a challenge. And the first challenge that we have obviously seen is that that type of investor also means that they can put in 50 rands today and they might need it tomorrow. And from our side, obviously, this creates an admin challenge. And currently, our workforce would not be able to, I think, deal with the sort of flow of funds that is likely to happen as soon as we introduce the top-up bonds. We have to first still improve our infrastructure, increase our workforce to deal with those challenges. I mean, I think it's going to be like a mammoth challenge to be able to really access that market generally. And we're not under any illusion that it's going to be like a breeze dealing with that market. But I mean, because we're doing research, we in fact have done research along those lines. It means that we then have to put in place mechanism to deal with it. Interestingly, just as another point that I can throw in, we're seeing a lot of interest from other countries coming in to see how we deal and how we manage retail bonds. I mean, it really means that we have become some sort of a trendsetter in the retail space. And we've got visitors coming through from Indonesia in the coming weeks. A high delegation from government of Indonesia coming to see how we work, how our retail bonds work. I mean, it means there's something really that we're doing right here. And it's for us to start improving and making sure that, in fact, the goals do get achieved at the ultimate end.
There would be skeptics who would say, oh, okay, hang on, backed by government, is that a good thing?
Yes. Well, yes. I mean, we have recently, in January, issued a global bond, about $1.5 billion, that was bought by global investors. And over 200 global investors, hedge funds, fund managers, had interest in the government issue. So there's so much confidence in the South African government. And on a weekly basis, we auction government stock to investors, asset managers locally. Even within those auctions, you get interest from foreign. So South Africa, as a sovereign, in fact, is looking very, very healthy compared to what is happening elsewhere in the world, in Europe, you name, and all parts of the world. South Africa is in very good standing. I mean, you might have heard stories about revisions from Fitch, Moody's, but those are not the worst that could have happened. Other countries were in fact downgraded. So as a credit, we're looking by far one of the healthiest countries in the world at the moment. So if you're looking for safety for your money, you don't have to look that far. And we offer safety because it's government guaranteed. Over and above that, we will struggle to find an instrument that will in fact beat the returns that we're offering. And can I also add that when there's this comparison between equities and bonds, and you always get advice that equities will give you better value compared to bonds and all those things. If you look in the last 4 years, 5 years, that in fact has been very much a fallacy. And when you look at your investment in equities, and I'm not saying that you must disinvest from equities, but I'm just saying you must look at the risk aspect of it. And because we're talking about government guarantee, government backed, what you don't normally get told is that you must look at your risk-adjusted returns that you get from equities. Because equities, you can get wiped out in no time. You can wake up tomorrow, they tell you US markets were down 20%. Then you must know, therefore, that the local markets, when they open, they're following in the same direction. So that risk element is not properly communicated. Whereas when we say you're getting 7%, 7.5% on your retail bonds, you're getting 7.5% on your retail bonds. And it ends right there.
I suppose once again, it's what we've been told so many times whenever we've looked at investments. It's taking your risk profile and assessing it and seeing where you need security, where you need to be a bit more risky, and where you need to have a bit of money that's liquid, and make sure that your whole mix is right.
Indeed.
And this is obviously one of the instruments that a normal South African, like when we opened the show, you said you and me should be looking at to ensure that they have that security within that mix of their investments.
Indeed. And unfortunately, I think most of the funds, as a worker anyway, they tend to be invested through pension funds. I mean, you might think that you don't have exposure to government bonds or you don't have exposure to equities. Meanwhile, you have.
Yeah.
Because you've got a pension. The pension is managed by a fund manager that's sitting somewhere in the towers of Sentinel in Cape Town. They're investing your money in equities and in bonds. Just that they're using their own discretion to say, we'll invest 90% of your money in equities and only 10% in bonds. So when the markets go wrong, you know that 90% of your pension is going in the wrong direction and only 10% is secure. And that's where I think suppose some activism, some involvement needs to come from. I don't know who the stakeholders that have to be involved in this would be to say, okay, now do you go for more security? Do we govern this to ensure that funds get as you grow older? Then we say then your investment should be skewed more towards much more safety than more. Because people do retire and they find that what they thought they had as a pension, in fact, is worth very little, and because they retire at a very bad time in financial markets.
I suppose one of the other ways of looking at it is saying one of the stakeholders is you yourself. And if you can go through to your HR department and say, where is my pension money being invested? And if you believe that there's not enough in bonds, for example, you can go out and do the same thing for yourself and protect yourself as well.
Well, I would do that. And I think as I say, that it requires some bit of knowledge. Because I mean, most you find, I mean, you've got one of the largest pension funds in say in a government employee pension scheme, and I mean that many of the people that or the monies are managed through that, you might find that they're not as financially literate, and the money ends up in the hands of asset managers, and they use their own discretion how. But you do get a portion where it's prescribed, and people do get forms where they fill in to say, I want high risk, I want medium risk, I want this.
But at the end of the day, you've got to look after yourself as well.
Well, you need to get involved, and otherwise you're going to get a shock at the end of when you go on pension, and when you look at your pool, you realize that there's actually only 5 years worth of funds in your pension.
Monale, unfortunately we're out of time. Thank you very much for bringing us up to speed on retail savings bonds. It's been wonderful talking to you. Thank you for your time. Hopefully you got all those details that we put up on the screen as to how you can get involved and get more information on retail savings bonds. Venture capital and private equity. I haven't got a clue what they're all about. I know a little bit about them, but we'll try and find out more next week on Mansfield's Money Sense. Have a good week. We'll catch you next Wednesday. Bye-bye.